would like, if I may, to take you on a strange journey.
Hello, everyone, and welcome to another edition of Real Estate Realities with the Rebel Broker. My name's Robert Whitelaw, and I am the Rebel Broker. Licensed real estate broker in the state of California, member of the National Association of Realtors. But please, today is a weird one, I know. The show usually pops up at 2 a.m. Pacific time each day of the week. Today, it's a little late. Apologies to all those East Coast folks who have finished their commutes. You're in your cube or your office and you've got that first cup of coffee going. And your phone dings at you and says, hey, here's your episode of Real Estate Realities, the Rebel Broker. Well, at least you've got some company for driving home. And of course, I'm sure you have some other podcasts you listen to on the way home. But anyway, something to fill in perhaps some quiet moments during the day. Today we're going to bring some interesting ground truth. We talk a lot about different things, right? We cover articles and information on what's going on in real estate. That's what we do here. But another thing that I like to bring to the table is my real world experiences as a real estate broker and also as someone who is investment minded and also someone who's going through the process of preparing my home for sale or potentially for sale. You know, now that I'm where I am now, I may change that strategy. I really don't know at this point. Before we get into all that, though, let me remind everyone how to reach out. The best way to do that is to head on over to therebelbroker.com, click on the menu item titled Contact, and then you can reach out to me that way. Of course, we are still doing the $50 Amazon gift card giveaway. We do that every month. We have done it 4 months for a grand total of $200 handed out to 4 lucky winners. And if you would like to get your name in the hat to win that $50 Amazon gift card, just head on over to therebelbroker.com. You'll find a red button at the tippy top of the page titled Take the Survey to Support the Show. You'll be asked for an email address 2 different times. Use the same email address both times and then answer a handful of questions, and you are in. So there you go. In addition, if you'd like to get access to exclusive content or get access to content early that I create, you're going to want to become a member of the Rebel Underground. To do that, just text the word Rebel Broker, the number 44222. That's text the word Rebel Broker to the number 44222. And that's all there is. Pretty easy, huh? So let's go ahead and jump in. I was debating whether or not I was just going to tease the whole ground experience thing and do it at the second half of the show, but you know what? That's why they call me the Rebel. I just don't. I don't know. That just popped into my head. I apologize. Anyway, so I wanted to give you an update because it's an interesting one. We have talked before about how there have been an increasing number of HELOCs done. Well, at least the last time we talked about it was probably around July of last year, and we were reviewing a jump in the number of HELOCs. Well, let's talk about HELOCs for a second because that's what, and for those of you who don't know, a HELOC is a home equity line of credit, and it allows you to borrow money based on the equity that you have in your house. So, and it won't allow you to borrow more than you would normally be able to borrow to purchase a home conventionally, right? So, if you have, let's say you only owe 50% of what the home is worth in the marketplace today, or what it would appraise for today, because that's how they're going to determine the number. They're going to appraise it. Usually this is a drive-by appraisal. They don't need to go inside the house normally. But that would mean that whatever, if you've got a situation where you owe only 50% of what the home is worth, you'd be able to borrow up to 80% of what the home is worth. So 30% in this case, if you happen to only owe 50%. I hope that, man, I feel like I phrased that really in a confusing way. But the bottom line is, if you owe less than 80%, you can get a HELOC usually that'll push you up to no more than that 80%. And some HELOCs are even more limited than that. but that's generally what I've been seeing in my shopping. Because the reason I bring this up is I decided I wanted to use a HELOC to do the remodel of my home for when I plan to sell it later this year. I had a great grand plan, like so many other people do, and there have been obstacles thrown in my way that we've discussed in previous shows as I've gone along. But the HELOC is the most recent stumbling block. And what's interesting is I was being solicited by lenders to get a HELOC. So I went ahead and jumped on board with the bank that I bank with, figuring they can see how much money I have in the bank. They can see some of my other funds. So these would be folks who would make it the easiest for me to get my HELOC in short order. One reason why I bring this up is I had to delay one of the upgrades to my home that I'm planning. Let me give you the timeline here. So I go ahead about a month and a half ago and get the ball rolling with doing my HELOC. I send them all the documents they ask for. Everything apparently is going fine. And then Thursday or Friday last week, I hear from them, everything's fine. We've got all your documentation and everything looks good. So we're good. We're good to go. So I figure, great. So I go ahead and sign the papers to get work started on my house. And I'm getting a variety of things done. I'm going to be replacing some windows. I'm going to be replacing the cabinets in the kitchen. I'm going to be doing some master bathroom work. And I didn't really want to sign any papers until I felt confident that all the financing was lined up. Get a call. And so I go on Monday morning, I sign all that paper and I send it into the window people. 2 hours later, I get a call from the HELOC person telling me that the underwriters had turned down the HELOC application, which was odd because that's the opposite of what I'd heard on Friday. So because of the way the contract was written for the windows, I had 3 days to change, alter, delay, or cancel. So I said, just put it on hold. Let me figure out what's going on. And that's where I am. This all happened. This all went down this last Monday. And I wanted to sort of get a feel for what was going on before I told you all about it. So let me give it to you, because hopefully this will be something that if you're going to do a HELOC and you have a timeline like I did where you wanted things to happen in a certain way. Now, just as something to know ahead of time, I scheduled, or I guess scheduled is the wrong word to use, but I anticipated problems. Anyone who's been in real estate long enough knows things always go wrong. So it's always nice to have buffers. If you create a schedule where you want to be on the market at a certain point, you need to make sure to give yourself enough elbow room at different primary points along the path to anticipate delays, right? So I'm not behind schedule now because of this. If anything, I'm more on schedule just because of this delay, but we'll see how it all plays out. So that's number one. Anticipate delays, expect delays. It's difficult to anticipate exactly what those delays will be, but add in days that you're going to have to take in order to square away some of these problems. All right. So, and don't let these things stop you. It's just a question of coming up with another strategy, approaching it from another angle. So in my case, I pushed back, and because all the math worked, right? And the person who was doing the loan with me agreed with it. We're not real sure what the underwriters had a problem with. They said it was the ratio of loan to debt, which is odd because that ratio we sent to them was a perfectly adequate number. So anyway, I'm going to get more details from them. I was supposed to get those details Tuesday or Wednesday. I did not get those details. And the fact that I'm getting that kind of a response is telling me I need to push with other options. Okay. Firmly believing that the folks at Chase would drop the ball. Despite their expressions of we'll figure this out and we'll get around it. About 15 seconds after hanging up with them on Monday, I was back out searching for more lenders. So I went and I went back to the page I had originally gone to Lending Tree, where I didn't get the kind of leads I was hoping for originally, but went ahead and pinged some of these folks. And here is what I have learned about HELOCs over the last couple of days that I think are valuable for you all to know. So number one, none of these folks want to be in the number two position. They don't like it. They don't want to be there. And when you go up to LendingTree and you apply for a HELOC, 90% of the folks who respond are not going to offer you a HELOC. They are going to offer you a refi, which may or may not work for you. But if you're in a situation where you don't want to incur a bulk debt, for instance, in my case, I'm asking for X amount of dollars, knowing full well that I may not borrow all that money. I may only borrow half of it. I may only borrow 75% of it. But I didn't want to incur the debt of the full amount, including a fudge factor. Because remember, we always plan for bad things. So if you budget X thousands of dollars, always make X thousand plus some number of thousands, because something is going to go wrong. And some of it's going to involve things that cost something. So in any event, now the strategy of only being approved to borrow up to my maximum amount, but borrowing less than that is now not part of the plan. And the folks you'll talk to, you may get different stories. I talked to a variety of different lenders. One lender said, "Oh no, we'll do a HELOC for you. But in order for us to do the HELOC for you, you have to refinance your first, then make that your first with us, and then we'll write you a HELOC as a second." So what they're basically saying is the only way you can have a HELOC is if the same institution that's giving you the HELOC is in the first position of is the primary loan, right? Is the first loan. If you want to have a HELOC, and this is from my experience over the last few days of talking to a lot of different lenders, that's what they're looking for. So you're not going to find a Wells Fargo that's willing to give you a HELOC on a Chase loan, or Penny Mac being willing to give you a HELOC. Actually, I don't know. Penny Mac also pinged me about giving me a HELOC, and then when I go and talk to them, they're not offering me a HELOC. They're offering me a refi. So just kind of keep that all in mind. And so for me, my plan, this hasn't derailed anything. It has slowed things down. It simply means I'm going to go ahead and I'm going to do a refi, and probably go. And in this case, the refi that makes sense for me, what's the rule we've always talked about in terms of picking your loans? The refi for me that makes sense is whatever the lowest rate is, regardless of duration of the loan. So I'm not going to get a 30-year loan. I'm not going to get a 15-year loan. I'm going to get an adjustable rate mortgage, because I know for a fact I am moving out of this property in less than 5 years. It depends on which kind of adjustable rate mortgage you get, 3-year or 5-year, but I know that I'm moving within that time frame. So that makes it easy, right, in terms of choosing. But it does mean that you want to shop for the lowest fees and all these other wonderful things. So if you find yourself in a similar situation, probably smarter to, if you really want to do the HELOC thing, first approach the lender that is in your first position. So if your loan is with Chase, go talk to Chase, and potentially they'll be willing to write this. If you are with PennyMac, then go to PennyMac, and they'll probably push you towards a refi. But their little blurb did say HELOCs. No one wanted to talk to me about a HELOC. But my point is that the institutions that are going to be willing to give you a HELOC at all are going to be ones where they are already the holder of your first mortgage. So just kind of keep that in mind as you go forward. In terms of real delays, what's interesting is there is no real delay between a HELOC and a refi. The last refi I did was when I got divorced about 3 or 4 years ago, and that literally took something in the neighborhood of 20 days to get completed. A refi takes about the same amount of time. Basically, the same process is gone through, with the possible exception of an appraiser coming in and actually needing to get inside of the house. If I recall correctly, when I did my refi, the appraiser couldn't do a drive-by. They actually had to come inside. So that's about it. I wanted to give you the latest update. It doesn't stop the process. It just means you need to step back and figure out another way to get access to the equity that you have in your home. And for me, it looks like that's going to end up being a refi. And we'll have to see what I can push through there. But it's absolutely delayed getting the work started on some of my projects. But again, started those early enough that I was going to actually have probably about a month leeway before I actually wanted to go on the market. So far, so good. All right. So let's go ahead and take a quick break. When we come back, we'll cover some other interesting stuff in real estate. So don't go away.
Are you ready to jump in and start your search for your first investment property? Maybe you've decided that it's time to own your own home, or maybe you're ready to sell your home and move on to something new. No matter what your goal is, the Rebel Broker can help. That's right, aside from hosting this show, I am also the owner, broker of Whitelaw & Sons Real Estate Services right here in Silicon Valley. With over 25 years experience serving Silicon Valley, Morgan Hill, San Martin, and Gilroy, I or one of my great agents can help you achieve your goals in real estate. So if you're ready to look into taking that next step towards achieving your real estate goals, point your browser at www.soldbyrobert.com. That's www.soldbyrobert.com and get in touch. Let me show you how I will earn your business and your respect. Again, that's www.soldbyrobert.com, or you can call me at 408-852-0525. California Bureau of Real Estate ID 00984-909.
Welcome back, everyone. We were just getting a little bit of ground truth on my experience relating to financing the remodeling costs of my property, which I'm going to be putting on the market this year. Ran into a problem getting a HELOC, having to back up and apply for a REFI. All that's fine. It doesn't stop the process. It just delays it a little bit. But if you're planning correctly and understand how things can just pop out of nowhere to slow you down, and then have a backup plan, you'll be able to push through these types of things. Now, we've talked a lot on this show about interesting things that folks seem to want to ascribe to why things are going fast or why things are going slow. Now, since the last time we talked about them, interest rates have actually gone up. Let's see. Interest rates are currently, the 30-year fixed rate is currently at 4.28. So that's an increase of 0.05. The 15 years at 3.47. But we're talking relatively small increases. The biggest increase was actually with the FHA 30-year fixed, which had a 0.1% increase. So, and my contention has always been that in this bracket of interest, nobody is going to stop their decision to purchase based on this. The history doesn't bear that out. No experience bears that out. And yet, you get these shocked, open-mouthed looks from some of the real estate experts out there when you don't see a decrease in applications based on increases in interest. Headline from CNBC: jump in rates doesn't deter home buyers as mortgage applications increase 4%. Well, okay. With the rate that we're at now, and it confuses me as to why folks see things this way, but mortgage application volume rose 4% from the previous week. Not a huge number, but an increase. The mortgage bank, which is also normal for the season. So, and even in talking about rates, we would expect things to start increasing in late January a little bit anyway, because that's what happens now. Martin Luther, let's see, it included an adjustment for the Martin Luther King Day holiday. Volume continues to lag last year, however, by 18%, mostly due to the fall off in loan refinances since rates shot up after the presidential election. Refinance volume did move slightly higher again last week, up 0.2%. Seasonally adjusted, it had jumped sharply the previous week after outgoing HUD Secretary Julian Castro announced a quarter-point drop in the FHA's annual mortgage insurance premium. By last week, there was already considerable speculation that incoming HUD Secretary Ben Carson would reverse the move, and in fact, that was one of the first acts of the Trump administration. And despite all of this, right, there were an awful lot of claims about what was going to happen if interest rates went up, what would happen if they got rid of this premium reduction for the FHA stuff. And it hasn't affected the volume. The volume is down from last year, but it's up month to month. So the market just continues. So what do we learn from this? What's the takeaway that we can get from this news? Well, I think it reinforces what we've already talked about from our experiences over the last few months. it's going to be a relatively flat year. It's interesting that we're continuing to see increase in activity in January. There was a time way back when it usually didn't happen, at least in my marketplace, and it's absolutely happening in my marketplace, when you didn't tend to see the increase in loans, the increase in contracts start in January. It was usually at the earliest February, and even then late in February. But we've got this new dynamic that we have since the downturn, particularly since after the downturn. So when things finally started to recover, earlier in the year tended to be the norm, and that's continued to be that way for the last few years. But again, at the rates that we're seeing it, I'm anticipating a much flatter increase. So, and this is something my buyers are asking me right now. I have some buyers who aren't really in the market to buy this minute. They're kind of trying to get things in a row, and they're looking at waiting. So one is looking to wait as much as a year from now. One is looking to wait till summer so their kids are out of school. And they're asking, what's going to be the impact? I've been sitting back on the sidelines of this marketplace, watching things grow at these rates that make it so that I can't buy the house I could have bought a year ago now. And the answer to that, I think, is we're going to see an increase, but we're not going to see the level of increase we've seen before. In a lot of areas where you've been seeing, 4, 5, 6% year over year increases and greater than that, I think you're likely to see maybe 40, 50, 60% of that increase this year. I think what we'll think of this year, once we look back on it, once we hit December and we look back on 2017, I think a lot of folks are going to look at it as a relatively flat year. We had a pretty big 2016 in some markets, although we did also see a little flattening in 2016. Not as much as I had anticipated for that year, but given the trends we're seeing in 2016 moving into 2017, it wouldn't surprise me if that ends up being the reality that we live in. Now, one final thing I wanted to hit today before we close it out was discussing briefly where homes sold the fastest this winter. Kind of an interesting thing to note because it can give you an idea of either an up-and-coming market where things are really starting to get hot or a market that's already very hot. And this list is really no exception. I think it pretty much bears that out. We've got 5 metro areas that had listings that stayed on the market for the shortest amount of time in December, and that's according to Realtor.com. So I thought I'd run down this list. And I want you to pay attention to how many days this is, because even these days on market is higher than if we consider the same time in past years in terms of how many days it was taking to get a lot of these homes sold. Now, number 5 on the list is Hanford, Corcoran, California. Never even heard of this place. 51 days. An interesting entry on the list at number 4, Billings, Montana at 51 days. I'd love to find out why Billings, Montana has seen homes going so quickly. It could just be very low inventory with a lot more buyers out there. Number 3 on our list is Nashville, Davidson, Murfreesboro, Franklin, Tennessee at 50 days. And of course, the ones we always see at the top of this list, San Francisco, Oakland, Hayward, California, 50 days. San Jose, Sunnyvale, Santa Clara, California, 49 days. And because of the way they're blending these communities, I think that's why these numbers are a little bit higher than I expect for a lot of areas. There are some areas that I'm seeing where properties are on the market 27 days and 31 days. So there's what's interesting about this is usually when you see that, what I like to look at next is prices. So if you are in a community and you're looking at your days on market and you think it's a very low number, the next thing I'd suggest you look at from your real estate person is look for the chart out the cost of the property versus the days on the market. This is a great one because I personally can get a lot of info from that and base a lot of decisions on that. If you see that it's taking 5 times the normal number of time to get a home sold at a certain price bracket, when you're doing a flip or trying to sell your home, that's a price bracket you probably want to avoid. So strategically pricing, and this feeds into something I've talked with folks before about, which is I call it price banding. I don't know what anyone else calls. I'm sure there's some more technical term for it, but it's analyzing how long it takes different properties to get sold against the price that's being charged. And you'll often find those trends where and it can be a very bizarre trend. I remember that we had a trend here in Morgan Hill, it was probably 2013 or 2012, where it was all fairly normal. You had a 10-day increase way up at the high end, anything from $1 million to $1.5 million. Anything above $1.5 million, you had another 20 days that got added onto it. But it wasn't a consistent thing. What was bizarre was you had this huge jump in how long it took to get a home sold right there in the middle. Anything below $500,000 was selling in a week. But anything from $600,000 to $700,000, it was taking more than everyone else. It was this huge jump in how long it took to get a home sold in that price bracket, and it made no sense at all. Maybe looking into more data, it might have made sense, but the point is, knowing why isn't as important as just knowing that it's happening. And if you are $1 inside that price bracket, you may be getting negatively affected. And what's particularly nuts is you may find that if you increase the price of your home by a few dollars, so it's beyond that next barrier, right? Where in one price bracket, it's taking 60 days to get a home sold. In the next higher price bracket, if you're already up at the top end of that bracket and you get your home priced into that next bracket where it's selling in 40 days, you may suddenly find that you've increased the price of your home, but you've also increased your probability of getting it sold faster. So I realize that's counterintuitive and it doesn't always work that way, and I haven't seen it work that way since then, but something to be aware of in your particular community, so that you understand that you're calibrated to the right amount of time that it's going to take your home to get sold, given the price bracket that you're in. Hopefully, if you get a real estate agent who's helping you, they're going to give you a market analysis that's going to compare your home to similar homes in your marketplace, and they're going to show you what the average days on market has been for those homes. But I'm also going to suggest that you ask them for this breakup based just on price. Usually there's not a lot of flexibility there, because people are not just shopping based on price. They're also shopping on number of bedrooms and bathrooms and some of the core things that folks look for in a home. But if you're, again, on the margins, nudging one way or another, maybe just dropping your price by a couple of bucks so you're into that faster selling marketplace, may get your home sold a whole lot faster and save you the holding costs and the delay costs that are associated with not getting your home sold in the time frame that you're hoping for. All right, folks. I do hope that for all the time that you spend here with me on the show, you are able to pull out tons of value in terms of things to think about, ways to potentially make your real estate experience better or make your investment experience better. The bottom line is, my number one goal with every show is to leave you with more tools in your toolbox to achieve your goals. Thanks for listening, everybody. I'll talk to y'all next time.